BMO TCH complex is that the 10-year ends the year more or less around where we are now. I think that a few reasons for that. First and foremost, we are of the view that the economic data, as it continues to come into year-end, doesn't support higher yields.
So you are a fan of corporate debt, not surprising given what's going on in Treasuries. You like metals and mining, and you like technology. What's going on in those sectors that are making the debt attractive to you?
Well, as has been highlighted for a number of years now, interest rates remain, in terms of their historical averages, to be low. So in order to find extra yield, we have to do a little extra credit work and find industries where maybe some of the headwinds have given investors some negative sentiment. So the extra yield that we can get above, let's say, Treasuries is very large. So metals and mining, commodity prices have been under pressure. The bonds themselves have come down in price and their yields are higher. And similarly with telecommunications, if you think about a few weeks ago, Verizon brought the largest bond deal to market, $50 billion. That reprices all the debt in the sector. So all of its competitors and their debt came under pressure and their yields went up as well. So we found some opportunities there. We think we have high quality credits but attractive yields.
When are we going to see another deal that size?
I would suspect that that's going to be a record for a while.
Really?
That was very impressive that they were able to do it, and obviously they were buying probably a unique asset in that they already owned a portion of it, Verizon Wireless, and it was paying so much cash flow off that it just made the financing work, but that's going to be hard to come by.
Let's move from corporate debt a little bit. What opportunities are you seeing in a high yield, if anything at all? Or are you looking at some of the lower credit emerging market sovereign debt issues?
We're looking at both markets, but very specific areas of both of them. I'll talk about high yield first. High yield, our view is that you have to keep things in balance. The first thing is that we don't want to go too low in the capital structure or go too low down into where high yield corridors are very low on the rating scale. In that those bonds, you have to really have a very special situation, a very high degree of specialty to assess those. We're looking more at what we call the upper echelon high yield names that are more liquid issuers, where you have liquidity, you can still trade around and take advantage of opportunities. Looking at some of the bonds that might be rated BB, who we think their rates have been low, they're refinancing, they can get upgraded. So we think the upper end of high yield, the higher quality high yield, if you will, makes a lot of sense.